What is up, YouTube? What's up, guys? The Composer Trader here, and welcome back to another video. And today, we're going to be talking about how you could have realized close to 20 RR with two single trades here in one range on ETH. And we're going to dive deep into the distribution and accumulation that allowed you to get that total combined of 20%. And we're mostly going to dive deep into the accumulation aspect because I posted the setup on my X and I got a lot of questions from different people regarding, the multiple taps, this and that. So going to dive deep into the high probability variables of it, and hopefully you guys can learn something. So I'm not even going to build any other context than the fact that we are simply in a range here on ETH. Okay, so price was trending down, making lower highs and lower lows. Following the 6 candle rule, we came into high time frame support here on the left, and from there we had our initial range low, we had our initial range high, and we got that rotation into the extreme discount section, actually sweeping extreme liquidity, which is the first higher low that's created inside of your range, and that's the extreme liquidity. So obviously, when price is sweeping extreme liquidity and is located in the extreme discount section of the range, looking for potential longs, trading low time frame accumulations in discount is the correct way of, trading in favor of the context. Preferably when to look for accumulations in discount and look for distributions in premium, while also watching for the main sweeps of the range low and the range high to watch for high time frame accumulations and distributions. But we came down here, swept at extreme liquidity, and that is where everything started, because typically, and this is going to be a very key point for you all to remember, so please pay close attention, because we're going to dive into some juicy details that can help you a lot when you're trading these TCT models. But when you're expecting some sort of a range to develop that could turn into an accumulation, obviously that range needs to create itself. And in order to create a range, you need obviously a lower high for a lower low here, and then price touches that equilibrium of this swing low to that swing high, and that's when you have your confirmed range, like here. So you have your swing low, you have your swing high, price comes back to the equilibrium, you confirm your range. But in order to get an accumulation, you need to confirm your range. So price needs to go up, and then price needs to go down again. So even though you are looking for some sort of an accumulation, that doesn't mean you cannot catch that scalp short opportunity that creates the range high. And you see this all the time. That price is downtrending, and then you get some sort of a distribution here on a lower time frame, right there. You get some sort of a distribution. Let's make that red. And then from there, you make the lower high for the lower low. That then ends up being the starting point of your higher time frame, 1, 2, and then potentially a 3, just like this. 1, 2, and a 3. Okay? So oftentimes, there are very high probability short opportunities, despite price being in extreme discount and having still have extreme liquidity, that you can still take, and you can take that towards the low, because that's what needs to happen if price wants to accumulate, and we're expecting some sort of an accumulation. Now, important to note, if you don't have a high probability short opportunity, don't touch it and keep your focus on the accumulation, because the accumulation is in favor of the context and the distribution is not. So only if you have a obvious high probability distribution model can you take that trade. Now, what we saw here, if we zoom in, we can see that right there, we can see literally a textbook example where your low time frame range goes over in the high time frame range with distributive price action. So what we see right here is price trending up, making higher lows and higher highs right there. And you can pull your range high from top to bottom right there. And then you have your initial range high, you have your initial range low, you have that deviation 1, extend the range high to the deviation high, and then you have your deviation 2. Okay? Now, this range is very small in size. This range is only an hour and 40 minutes. Preferably, my sweet spot for the ranges is around above a duration of 1 day. That's kind of my sweet spot. Sometimes I'll take less, but it will be closer to, 15 to 20 hour range duration, and not really the 1 to 2 hour ranges. But you can see right here that you did have that low time frame range. You got the 3 taps signaling a Model 1 distribution schematic. Got some sort of a return to zone, nice little liquidity curve, and price got that rotation back down right here, hitting the technical target. But because the range was so small, a single range like this is not capable of pushing price all the way back down towards this low because the range is too tiny. Then you should know from the TCT mentorship that low time frame ranges can go over into high time frame ranges. Now, as a fresh reminder, how do they do that? Well, either you get just a simple, low time frame break of structure just like this, and price recovers the entire break by taking that high again, where on the higher time frame, this is simply one higher low for the higher high, and this is your range to begin with. Or you get your low time frame distribution model that hits the technical target and then comes back up, where again, if you zoom out on a higher time frame, the entire distribution on the low time frame disappears, and that's a simple market structure pool. So if I go on, let's say, the 15 hour, you can see that tab 2 and tab 3 are not valid because you do not have, either way, this range is not even valid because you don't have the 6 candle rule in between the taps. You only have a move up and you have 1 candle going down. And after that tap, you have 1 candle going down. No 6 candle rule, meaning no Wyckoff model on that specific time frame. So if I have to draw my market structure on the 15 minute, it's simply a high for a higher low for the higher high. And that's it. So then you can draw your range again from swing high to swing low on the 15 minute, and then this becomes your range starting point. And now this becomes interesting because from here we can see a tab 1, we can see a tab 2, extending that range high to the deviation high, and then we can see that tab 3, signaling a Model 1 distribution schematic. And now this range is better in size because this range is around 5 hours and 30 minutes, which is still on the smaller end, but the overall distributive price action started at this high, which signals to around 7 hours. Again, still on the smaller end, but better than 1 hour and 30 minutes. Now, once you zoom in here, we obviously want to confirm the distribution. So then we have to check how did price develop here. So we have our initial taps there. Always make sure these dots are placed correctly. Got to keep it clean. And you can see that following your structure from low to high, you have high, higher low, and higher high. And in order to confirm that distribution model, you need a sweep of your range low right there. Or, apologies, not a sweep of the range low. You need a break of structure. So price needs to close below this market structure low in order to confirm the Model 1. But instead, we SFP'd our market structure low. And that is not a confirmation. So we cannot short here on the break of structure because there is none. But what we do know is that there's always the chance for our Model 1 distribution to go over in an extended distribution model where the Model 1 goes over in the Model 2. Right here, we can see a 5-minute order block. And that is also your extreme supply. So if price pulls back into your extreme supply, which is the POI for the third tap of a Model 2, then our Model 1 could go over in a Model 2 distribution, which would result in an extended distribution model. And we can simply analyze the structure from this low to that high. And if that breaks back to bearish, we can still take the trade. So if I go on the lower time frame right here, you can see that price following the 6 candle rule made a high and a higher low for the higher high. And right here, you got that break of structure. And then you can still short it on the break with the candle close above. Stop loss goes above that new Wyckoff tap, which is technically speaking the 4th tap. And you can target this low, but that is the technical target. And I just told you guys that we were expecting some sort of a higher time frame accumulation, we have all these lows here stacking up: 1 low, 2 low, 3 low, 4 low, 5 low, and 6 low. So you can extend that trade all the way down towards the actual low, which is the area that price needs to come towards if you want to turn it into a bigger range. Now, you don't need to keep the entire trade open. What I will do is simply, if price is coming towards your technical target, which is the range low right here, after sweeping this local sell side liquidity, simply take around a 15 to 20% take profit. You're up 5%. If you take a 20% take profit when you're up 5 RR, you realize 1 RR, meaning you're up 1%, while your risk goes down from 1 to 0.8 because you're taking out 20%. So that means you are 1% in profit and your stop loss is 0.1 or 0.2 or 0.8. Apologies. You're 1% in profit. You're de-risking with 20%. So your stop loss is 0.8. At the same time, you can also throw your stop loss. Either way, if your stop loss gets triggered, you are still up in profit, okay, with a 0.2 margin. So the trade is risk-free. And now you can leave 80% run all the way down to here, which will cause you to realize around 15 RR on this trade, around 15%. But this is a very common pattern where we're expecting some sort of an accumulation based on context. But in order to create that accumulation, we need a pivot point to create the range high. And that pivot point itself could be a distribution model that you can trade towards the range low. Okay? And that's exactly what happened here. And you can see that, it's beautiful. Again, the pivot point is created also on Sunday AM session, right? Yeah, Sunday in the morning. And, weekends tend to create amazing moves these days. So that was also an extra confluence. Personally, I did not manage to take that because I wasn't active behind the charts at 11 in the morning on the Sunday. But everybody that follows me knows that these are valid trades to take. And some people in the community also actually posted about this, talked about this, and shared it in advance. So from there, we must not forget the higher time frame context, which is simply that we are expecting some sort of an accumulation because we swept extreme liquidity and we are in extreme discount. So now, following this swing structure we were talking about earlier, you can draw it from swing low to swing high, and you can see that your range high is that high of the distribution, range low, range high, and this is simply your deviation 1. And from there, we can start looking for actual accumulation models. Now, the problem is, because we came down so fast, it's very hard to get some sort of a high probability accumulation model, because preferably you want to create some sort of a liquidity curve coming into that third tap. But because you're coming down so fast, there's no opportunity for you to get something like that. So we're getting these move down, we're getting the move up, and we rejected from our structure supply, which is nice because that means if price creates some sort of a third tap here, then that supply is not there anymore to hold price back, to make price reject. However, we did have a more refined structure supply POI right here that price ended up rejecting from. Okay, so despite us tapping into the higher time frame structure supply following this pull on a lower time frame here, not on the 10-minute because you don't have the 6 candle rule, but on the lower time frame for sure, that's also a structured pull, and you can see that you have that structure supply creation that price ended up rejecting from. But this right here, price came down immediately, and it came down very fast. Okay, it came down pretty fast. And if we go on a lower time frame, you will also see that there is not even market structure to confirm a good looking entry. So right here, when we follow the structure, price is coming down incredibly fast. Okay, there's no slow curvature like this coming into that third tap, waiting for a pop back up. And right here, when we follow the structure, between the highest point between tap 2 and tap 3 down towards that third tap low, I'm going to skip over these first few points, but our most recent market structure high is all the way down, all the way up here, that we SFP'd in the first place. And then from there, we only broke structure right here. So if you wanted to confirm this Model 1 accumulation, where price has its range low, has a deviation, and then has a tap 3 with the breakup structure, you would need to enter all the way up here on the close above, stop loss below the low, while targeting the range high, which is only a 1.5 RR, while having resistance above, while tap 3 or tap 2 and tap 3 aren't even high probability taps because there's no slow move down coming into the taps. It's a structured, very structured, fast move down, just like this. Oh, very structured, fast move down, making lower highs and lower lows. Compare that to the Model 1 distribution from here above. It's the same, but the other way around. You can see that you have these lows building up here. Beautiful lows building up straight into that point. The nice curvature. You don't have that here. You just have a structured, very fast move down. So that's not good, right? You have a Model 1 accumulation, but it's not a high probability accumulation. So we don't want to take it. We don't want to take trades like that, especially when it's 1.5 RR with room of error with that supply zone. So then I'm asking myself, well, because this is a very fast and structured move, can we still validate a potential higher time frame accumulation? So I'm thinking of the concept explained in the advanced lecture of the TCT mentorship lecture 6. Can we go on a higher time frame where then tap 2 and tap 3 merge into one tap because there's no valid 6 candle rule? So if I go on a higher time frame here, on let's say the 1 hour, you can see that there is no 6 candle rule in between our tap 2 and tap 3. So we have 2 candles coming down. We have 2 candles coming up. We have 2 consecutive candles going down here. We have 2 consecutive candles going up. It may seem like a doji candle, but if you zoom in, it's a bullish candle. But you only have 1 bearish candle. We need the 2 consecutive bearish candles trading lower than each other to validate the Wyckoff model on this time frame. So on the 1 hour, and the range is still valid on the 1 hour because you have that beautiful 2-2. These 2 taps merge into one tap where you have your tap 1, and this is just one individual tap 2, and that disappears because you don't have the valid 6 candle rule here. So it's just a move down. It's a move down, it's a move up, and it's one move down because you can't draw the structure there because there is no structure. And from there, price gets to move up into resistance and then gets the other move down. And here you can see 2 candles going up, 2 consecutive candles going down right on these 2 candles. And then you can have your higher time frame third tap. So on the lower time frame, it may be 4 taps, but it can still be validated on the higher time frame as a Model 1 accumulation. And this is an example where your low time frame model goes over into a higher time frame model. And that has been explained in the mentorship. But again, you can see right here, and mind you, these are the periods where I am not active behind the charts anymore because I'm going to bed to wake up early in the morning because it's around 12 p.m. But you get a very fast move down. So when I go on the lower time frame to look for a structure confirmation, there is simply no structure here. Like there's no structure here up until this market structure high, which brings us to the same situation where it's like, okay, if you enter there, you're trading less than a 1-to-1, which is not something you want to do, right? It's literally a 0.8 RR, which is not something we do. So despite us having a confirmed higher time frame Model 1, because we did break structure, so it is technically confirmed, price should rotate back towards the range high prior to taking out this low. It hasn't given us a good entry yet. But now we know, okay, we have a higher time frame Model 1. We can retrace and price could go over in a Model 2, an extended model where the Model 1 flows over into a Model 2. Right? So then we're going to check what are the third tap POIs for price to actually put in that fourth tap where we can confirm the Model 1 going over in the Model 2. So I'm looking right here and I'm seeing, okay, from a liquidity standpoint, this is the first higher low for the higher high that's created, making this your first market structure low and therefore your extreme liquidity POI And from a demand perspective, right above it, we have a 1-minute demand zone. So they're kind of in the same area. And we can see that price right here came back down towards that extreme liquidity POI, swept it, and then broke structure back to bullish. Let me quickly check. Low, a move back down, a move back up. So that changed it to here, and then one move down. So again, here, you didn't even have a valid structure. Right there, you didn't have valid structure because you had a move down, and this is the highest point before price retraced back down to take the low, and you only have one candle going down in between the high and the low. Only one candle. These two candles do not matter because they're not in between the high towards the low, which is the current move down. They're part of the move up, which doesn't matter because you need 2, 2, and 2. So it's the two candles going down between the high and the low. No structure here as well because, again, we have a very fast move down. We don't like these fast move downs, guys. You don't want price to dump down this aggressively into your POI where you want to enter on the break of structure because, one, it could be structureless, allowing for no break, but two, there is no liquidity curve. We want price to slowly make its way back down into our POI, creating structure, leaving all these highs intact for us to pop back up, okay? Now, right here, we did validate that fourth tap from a POI standpoint, and then higher up broke structure again, not allowing for an entry. Simply doesn't allow for an entry with a structure break up there because your entry will be here and your stop will be there and the target will be the same, which is almost, again, less than a 1-to-1. So despite price having a confirmed Model 1 going over in a Model 2, we still don't have an entry. And now this is where things get interesting. Okay, this is where things get very interesting because when you have a model that could be a Model 1, could be a Model 2, or could be a Model 1 flowing over in a Model 2, it can always be an extended model on its own. Meaning that despite having the proper Wyckoff taps already in place, a 1, a 2, a 3, in this case also a 4 because it's an extended model, price can always come back for extreme demand or extreme liquidity to create the fifth tap to then push back up. And that's simply called an LPS in Wyckoff terms. It's just a higher low. It's after the fact that your Wyckoff taps are already confirmed, you can just get a higher low. And you can only get one. Okay? Sometimes you'll get two, but the more higher lows you create, it just showcases a lack in follow through. Because in this case, after the 5 taps, price and market makers had enough opportunities to fill longs to push price and reverse price back up. Otherwise, it just shows literally a lack in buying power. But after your confirmed Wyckoff taps, and the 1, 2, 3, and 4 are Wyckoff taps because it's a Model 1 going in a Model 2, you can simply get a higher low. Now, if you already had a confirmed Model 1, and then you get your retest, and it's not valid from a Model 1 going into a Model 2 perspective, and then you're getting retest after retest, it's signs of weakness because price should just go. But in this case, there wasn't an entry. You had an entire Wyckoff model, but there hasn't been a single entry. So it's not like that price is struggling to move back up and it should be moving back up. There wasn't even an entry. If you had an entry and you already had all the taps established and the retest, and then you keep on coming back, now it's weak. Okay? Now it's simply weak. But that wasn't the case here because you had nothing but fast moves in between these taps. And that's why I wouldn't have traded, or you shouldn't have been able to trade any of the previous taps. Right? People ask me online, but how did you prevent not entering on this 2 or on this 3 or on this 4? I'm like, well, I would have if I had the chance, right? But there's not a high probability, and there wasn't even a structure break to begin with. So now we're looking for a fifth tap, okay? And a fifth tap, I treat the requirements the exact same as on the 3 tap or on the 4th tap, which is either extreme demand of the move, which is right here, or extreme liquidity, which is the first market structure low that got created. And right here, boom, we can see that happen. Okay, we can see it happen where price is sweeping that extreme liquidity perfectly, absolutely beautifully. And now there should be something that catches your attention immediately when I'm looking for an entry. Because there's one big difference between this tap compared to all the other taps here from an entry perspective, making it better for us, making the entry more high probability. And that is that between your fourth and your fifth tap, you can see that price went up and slowly went down. Look at that. It slowly went down, creating lower highs and lower lows here. Slowly. Creating that liquidity curve that we so much desire, where all these lower highs are stacking up to be lower highs compared to the previous one, with no resistance in between, just lower highs, and lower highs. Okay? That is the high probability aspect. If you compare this pullback between the taps versus your 2, your 3, and your 4, look at the difference. Look at this piece of price action in here. Look how you're pulling back. Look how slow. Look how fast it was here. Look how fast it was there. Look how fast it was right there. Fast, 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 slow. This is what you want to see, okay, for the highest probability entries. So right here, I'm seeing price come towards that POI. We're tapping it, and then, oh my lord, a beautiful, absolute beautiful low, lower high, lower low, lower high, lower low, break of structure, and then boom, long, stop loss below the low, and you target that swing high. And you know, having a accumulation model like this in place that is really extended, that should allow for potential follow through. And that is exactly what you're currently seeing, right? You can SFP this high temporarily, but price should have at least some follow through towards some more buy side liquidity here on the left, preferably up to this point right here, which is where the liquidity ends and the inefficiency starts, because of the extended model, right? It's absolutely beautiful. Now, there was an extra high probability variable that you could have added here to confirm and back up the breakup structure even more, but that's going to be for another video because I'm still back testing it, still gathering data on it, and then when that's all done, that should be released in the near future. But right here, you can see beautiful Model 1 into a Model 2 into an extended Model 2, which is just absolutely beautiful to see. Got the rotation back up towards the range high. And these models, guys, they have over an 85% win rate. And they're always around 3 to 4 hour minimum. And like you can do the math. If you grab a compounded calculator with 85+% win rates and 3 to 4 hours, they don't happen that often, right? I'm not saying they happen every single day. Maybe they happen once every 2 weeks like this clean once every 2 weeks. But when you do the math, if you only need 10% a month, only 10% a month to turn 1,000 into 100 million in the next 6 years. And if you don't understand that math, then watch the video prior to this video. Like, these are the models where you can double down, right? These are the models where you're willing to lose a lot of money if it fails because the probabilities are in your favor. So I hope this explains also the long model that I posted on my socials, and you guys now fully understand this. I've given a lot of sneaky tips and tricks in here that you need to watch out for when training the models. Also regarding high probability factors that are actually private lectures inside of the premium community on Discord. But yeah, guys, if you like the video, if you like my content, and if you want to trade these models live with me, which in my opinion is just a no-brainer, the Discord is the place for you. Okay, so if you want to join Discord, you can find a link to that in the description of this video, and I'll see you all in the next one. Peace out, guys.